Good morning and welcome to Technically Speaking Tuesday, except really today we're going to talk a little bit about fundamentals because the market was closed yesterday for the Labor Day holiday. The markets are back in swing this morning, a bit to the downside as really continued worries over emerging markets really continue to weigh on the outlook going forward because, again, emerging markets are very important to us in terms of economic growth and is really as a signal of what is happening globally in terms of economic growth and kind of where we're headed. But in the near term, what we're talking about today is earnings because, well, we just finished up quarter two and now we get a chance to look back over the last quarter to see what corporations really did in terms of earnings. In other words, where are earnings coming from and are those earnings supportive of asset valuations where they are currently? So we're going to talk a little bit about this today and fundamentally speaking rather than technically speaking. Of course, the big driver of earnings continues to be two things right now, which has been the impact of tax cuts, and then, of course, where did those tax cuts go? A lot of expectations were tax cuts were going to go to creating jobs and raising wages, but that really hasn't been the case as real wage growth remains stagnant now all year long. Yet what we have seen is a dramatic reduction in outstanding shares of companies on the publicly traded market. In other words, companies are using capital from tax cuts, repatriations, etc., to do some of the largest amounts of stock buybacks in U.S. history. At the same time, of course, as we reduce the number of shares outstanding, that increases reported earnings per share because the earnings are a function of the number of shares outstanding. In other words, if I have $1 a share in earnings and I've got 1,000 shares outstanding, well, if I reduce the number of shares outstanding, my reported earnings per share go up. So it's a great way to increase earnings without actually increasing revenue. And that's actually an interesting point here because revenue growth since 2009, now remember, this is at the end of the financial crisis, and reported earnings, and when we take a look at this, this is cumulative, right? So this is the entirety of growth from 2009 to present. Revenue, or what happens at the top line of the balance sheet or income statement rather, has only grown by 44% in total versus reported earnings per share have jumped by over 353%. So again, the point here is that large amounts of share reductions going all the way back to 2009 has led to a surge in reported EPS, and that is really at the mercy of the fact that revenue growth at the top line of the income statement really has remained very weak. And of course, really much more in line with what's really happening in terms of the global economic growth and really economic growth in the U.S. Economic growth in the U.S. has averaged about 2.25%. And so when you have economic growth running at that rate, it's not surprising that since corporations are a reflection of what happens in the economy, that revenue growth or what we're spending at the top line of these companies has really not grown all that much. Now, continuing on, we can see this again right here. This is the percentage change on a cumulative basis of earnings. And from 2009 to 2017, really reported earnings growth didn't change much at all. But yet here's your tax cut boost, a big jump, 29% in reported earnings per share. But yet at that same time, cumulative growth in the S&P up over 45%. Again, this is going back to just to 2014. You really have seen here not a lot of growth. All of a sudden, your tax cut boost comes in. And that's important because, again, as we look at where companies are manufacturing earnings and really getting growth from, it's not really coming from the organic side of the equation. Now, one thing about analysts, though, they're always optimistic, and especially when it comes to Wall Street, but even those estimates are now coming down. In just the last 3 months, estimates for the end of this year for earnings have already climbed from $153 a share to $142 a share. So that's over a $10 drop in earnings, but yet at the same time, investors are paying record high prices for the stocks they're owning. So even though estimates are declining as we look forward, investors are willing to pay more and more for a dollar of shares worth of earnings. And this isn't just now, this goes all the way into the end of 2019 as well, as estimates are already declining over the course of the next year also. So despite the fact that we have this record boost from earnings temporarily, Those estimates that we saw earlier this year are dropping rather dramatically as things like tariffs, of course, emerging market issues, etc., and the strength of the dollar are beginning to weigh on those estimates. Again, when we come back and think about this for a moment, investors really aren't paying attention to the fact that the cost and the price of what's being paid for every share of earnings is going up, not down. This also looks at another issue from the same aspect. Again, as we look at these earnings projections going forward into 2019, estimates for the S&P continue to rise of where the price target will be at the end of 2019, yet the expectations for earnings are declining rather sharply. One of these two things is wrong because historically, whenever earnings have declined, the S&P tends to go with it. Again, it is a valuation story at the end of the day. And again, as we can look at this in one other manner, is the fact that despite the fact that earnings estimates are declining, the one thing that a lot of people are not putting into the picture here is the impact of this ongoing trade war. The more tariffs that are launched in between countries on trade is going to erode the ability for companies, particularly multinationals, to generate more in revenue. And in fact, a full-out trade war could wipe out as much as 11% of the earnings growth expected, which would effectively nullify the majority of the tax cut bill that was passed last year and has been a huge source of the increases in earnings just over the last few quarters. There's one other issue that's worth considering right now as well. Currently, earnings at this point are deviated from their long-term growth trend at a level that have normally been consistent with, well, major issues in the market. The last time that earnings were this deviated from their long-term growth trend, we either had a liquidity bubble, a real estate and credit bubble, or a tech bubble going back to 1998. And again, it's not saying that this is going to happen tomorrow, but the point here is that stock prices move up in relation to earnings growth, and when that earnings growth begins to revert towards its long-term mean, typically stock prices get revaluated at that point. But again, we talked about this issue of valuation and reversions to the mean before, but this is one of the major things you want to look at is the direction and trend of earnings, not today, but where they're going to be in the future. And when you start talking about things like earnings growth, growth is relative to where it is. When you begin to look at year-over-year changes from very high levels, that earnings growth rate is going to slow over the course of the next few quarters. The important point to be made here is that whenever corporate profits are low, where prices of the market are trading, in other words, people are paying way more for profitability than they should, well, the markets have tended to revert. That doesn't mean it's going to happen today or tomorrow or next week or even next month. But the point here is that whenever this situation has occurred in the past, and again, all the way back through history, mind you, forward returns on the markets have tended not to be good, which means that this is why we have to be much more proactive about managing risk, managing portfolios, which is what we do here every day. And of course, this is why we bring you this information so you know what we're thinking and how to manage and how we're thinking about managing portfolios going forward. But if you have any questions, get by the website, realinvestmentadvice.com. Of course, I'm your host, Lance Roberts. Be sure and email me your questions and comments. Always happy to help you out. But again, realinvestmentadvice.com, and tune in today at 3 o'clock for the first edition of our live new podcast, The Lance Roberts Show, today at 3 right on the website, realinvestmentadvice.com.